Yeah, and right there, that's why NVIDIA, in part, is in investors, because you got the cameras on.
Drone defense technology, too, anti-drone technology. Ukraine has become
right
something
there,
of an on-ramp to
NVIDIA,
more of those defense dollars that maybe otherwise would have been harder for them to acquire.
Yeah.
Drone defense technology. Well, we're going to turn now to the broader markets and where investors can find opportunity. Artemis Global Equities Manager Simon Edelstein joins us now. He manages two funds with more than $1 billion in AUM. Simon, great to have you on the show today. Thanks for joining us. I realize when we talk about defense is very defensive within industrials. You're investing in industrials right now. What do you like?
Well, we tend to avoid defense companies for a couple of reasons. One of them is that governments are their big customers, and the second one is the order length is enormously long. So if you look at a company like Lockheed, which is a fantastic world-leading company and doing very well at the moment, amazingly, their earnings aren't going to go up for the next couple of years because they're still working off orders they took on over the last decade and facing a lot more inflation and costs. The areas that we prefer, which cover AI and cover the inflationary pressures around automation companies, we think that people haven't really got on top of this theme. It's a part of the industrial sector and therefore, not so much in the limelight as the technology stocks everyone talks about. And yet this is technology. This is applying technology to how you make things, how you make your factories more productive. How you deal with your supply chains. This is applying technology. And we particularly like the companies which are working out how to automate new industries. In the past, automation was really about car plants and steel plants and so on and so forth. And now we're seeing it going into surgery, food manufacturing, the most extraordinary new applications.
Interesting. Simon, Target reports in the morning, and you're not so much a Target guy, you're more of an LVMH and Richemont guy. So I wonder, in this economic environment where there are lots of questions about the health of the consumer, are you still betting heavily on that top-end luxury consumer, or are you more looking to diversify out of that, given what's happening in the broader economy?
Well, I think what you've seen over the last year is that as people come out from lockdown, people have got more money. The consumer's really healthy, particularly the American consumer. But what they want is treats. It may change over the next six months or a year, but the low-end consumer goods, the ones with smaller margins, the goods that haven't got a brand, are struggling a bit, and the retailers are trying to make sure that the cost of living doesn't go up too much for their customers. They're doing a pretty good job, but it squeezes margin. Whereas what we've seen is the most extraordinary continuation in the rise in sales of expensive goods, such as luxury handbags. And with China reopening this year, Japan still not quite open after COVID. I still think they've got a few more good years. And amazingly, the cash flows have kept up with the rising share prices. So, no, we're pretty happy with those holdings.
The risk-on rally in U.S. equities to start the year, does it have legs here? And I ask that because I know we've seen yields move higher, and we've seen some of those gains come off a little bit here in recent weeks. But is it sustainable?
I thought it was much too narrow. I think what we saw at the beginning of the year, it was quite interesting. In America, the stocks that led the market up were all tech stocks. In Europe, the stocks that led the market up were all banks. In fact, the American banks went down and the European tech stocks went down. So it was just a lot of money hitting the market, as far as I can see, and not really backed up by top-line growth. I mean, the FANGs have generally been downgrading their growth prospects. And you look at what people have in for this year now, just for sales growth in the FANGs. I mean, Apple is not expecting to grow its revenues. Alphabet's revenues are actually going to go down. So one, I think you can find much better growth outside them in the mid-cap area, some of these automation stocks, as I mentioned. But secondly, it just felt a huge amount of money hit the market because both bond managers and equity managers thought it was okay to sit on the sidelines for a lot of the end of last year. People got too gloomy at the end of last year. It's fairly simple. People thought the world was coming to an end.
U.S. or international stocks right now?
Well, I don't find, when you look at the best quality stocks around the world, and we just look at cash flow per share and growth, we don't find American stocks are any more expensive than any other companies around the world. We have rather more money in Japan as a region. I think Japanese